The next session is going to provide some insights into the future. We've got a presentation on a 5-year market outlook that will provide a look at some strategic considerations and some tactical opportunities that lie ahead. Now, Jim McDonald is the Executive Vice President and Chief Investment Strategist of Northern Trust USA. We're going to hear from Jim McDonald, who's prepared a presentation on his insights, and then after that I'll come back on stage and open it up for Q&A, and as always you can use your conference app to ask those questions or pop your hand up and we'll get a microphone to you. But ladies and gentlemen, please put your hands together for Jim McDonald.
As I was getting ready to come up to present, my colleague saw this headset on me and said I reminded him of Tom Cruise. Now, I don't know if you want to follow his investment advice, but it wasn't the bad thing to hear as you get ready to come up and present. A couple of things that I've heard in the earlier sessions today have talked around how do you separate the signal from the noise and everything that we're being bombarded with today, a lot on the political side, but also from an economic standpoint. And a lot of it gets around to politics, and if you look at what's going on not only in Australia, what's going on with Brexit, what's going on in the US, what's really critical is to separate out the noise that's in the media today versus the signals of what's actually happening from a policy standpoint. I'm going to share some thoughts about how we think about that strategically, so how we're viewing the world over the next 5 years. I'm also going to share some thoughts about our tactical outlook. So on a 12-month basis, how are we tilting portfolios? And the conclusion is, compared to a year ago, we have half as much active risk in our portfolios today as we did a year ago. So we've taken some risk in as the global economy has shown some wobbling, trade issues have come to fore, and interest rates have risen. That's all changed a little bit of the balance of where we see the opportunities. Quick comment for those that aren't familiar with Northern Trust. We're a large asset manager headquartered out of Chicago, nearly $1 billion in AUM, very large presence in Australia, headquartered in Melbourne. What this matters to me is that we have sufficient and significant assets in the investment area to help us pull together our investment strategy views. So I've got 3 objectives to accomplish with you today. First is to talk about our strategic themes and the tactical opportunities that we do see today. Secondly, I'm going to share our asset class outlook. So what do we think the return outlook is for fixed income, equities, and some of the other alternative asset classes? And then finally, I thought it would be fun to show a retrospective. What did we predict 5 years ago? What actually transpired and what lessons can be taken from that, because there are some clear lessons to be learned. So let's first talk about how we view the investment strategy world. We do take every summer a 5-year review of the economic and asset class return outlook over the next 5 years. We do both a quantitative and a qualitative approach. So quant models are great, but they also assume history repeats itself. Fundamental models can be good because they can take account history not repeating itself, but they're subject to personal bias. And so putting the two side by side, we think, has helped us do a good job annually with the strategic outlook. And then the tactical approach is an opportunity to take advantage of dislocations in the market. We meet monthly, come up with tactical views. I'll share some of our current conclusions here. One of our key considerations is you want to be very disciplined in a tactical approach. You want to reduce the chance that you're getting whipsawed by what's going on in the marketplace. So the themes that we pull together are one of the most important tools to separate the noise from the signal. Because if you've got good, firm, long-term views on things like growth and inflation and monetary policy, that will help you avoid getting whipsawed. So I'm going to run through the themes today. And then I also want to share some of the conclusions from the asset class returns that we have got forecasted. So I've compared these forecasted returns with what we've actually realized over the last 5 years. So over the last 5 years, a 60-40 global portfolio has delivered a 6.1% return. We now think that same portfolio will deliver about a 5.2% return going forward. So reduced return because equities don't have as much upside, offset somewhat by the fact that interest rates are higher. Now, coincidentally and interestingly, this return forecast on a US dollar portfolio, if you do it in Aussie dollars with Aussie fixed income, gets you exactly the same return forecast because of the similarity in interest rate structure. So reduced returns out of equities somewhat offset by higher interest rate opportunities. Now, from a tactical standpoint, the biggest changes that we've been making over the last year have been to tilt the portfolio back to the U.S. So we had been well overweight developed ex-U.S. and well overweight emerging markets through 2017. As the year has progressed since then, we've really pulled that back for a couple of reasons. Number one, we're seeing a shifting global growth environment. Secondly, we're seeing shifting risks around trade. And the U.S., we think, is the least vulnerable, but certainly not immune. And then thirdly, as interest rates have risen, we have reduced what had been a considerable underweight to investment-grade bonds. So you'll hear from me a little later that we think the outlook for interest rates remains relatively low for long. So that leaves us in a position today, significant overweight to U.S. assets. U.S. high-yield bonds, we think, look particularly attractive, especially on a risk-adjusted basis. And you've got to fund these overweights somewhere. We're still funding it out of the bond portfolio. One of the areas we've been most clear putting our money where our mouth is we have a 0% tactical weighting in inflation-protected bonds. We just think you're not going to get paid for taking inflation protection today, and so we've reallocated that into investment grade and into high-yield bonds. So less risk exposure than a year ago, but still modestly overweight risk. Let me hit some of the key themes. And so for each of these themes, I'm going to share what our 5-year outlook is, and then a quick comment on the current tactical environment. So the first theme is around growth. And we're calling it mild growth myopia. For those of you that heard one of the earlier sessions, a lot of concern about how long the expansion's gone on. It's going to end any day now because of that. Well, you have to look at how much growth has actually been realized as opposed to how many calendar months the expansion's gone on. This expansion started in June of 2009 in the U.S., and the reality is if we keep growing at 5 more years at a 3.8% growth pace, we're still going to lag the cumulative growth that was accomplished in the 80s and 90 expansions. So we think that people are too focused on the duration of the expansion, are missing the point that the slow pace means this can go on longer than it would otherwise be expected to. Now, from a tactical standpoint, we have absolutely seen a shift in momentum, somewhat tied to tax policy in the U.S., tied to the fiscal stimulus, but there's also been a rebirth of business optimism in the U.S. tied to deregulation and a degradation in business sentiment in the developed European markets because of concern around trade. And then from a Chinese standpoint, there's been a clear slowdown in growth over the last 9 to 12 months, starting to be offset by a jump in infrastructure spending. But on a relative growth standpoint, the U.S. stands out today as having the most durable outlook. And so we've positioned the portfolios in that way. The second theme is returned for the 3rd year in a row, the theme of Stuckflation. So you're all familiar with the term of stagflation, which is high inflation in a low growth environment. This is a theme where we just think inflation's not going to sustainably increase, which has really important implications for interest rates and for valuations and, of course, purchasing power. So if you look at what has happened since the financial crisis and the gap in price increases across the economies, you'll see that Japan is way behind the aggregate price increases that they've been trying to accomplish. It moves from there, Australia, the major outperformer, actually having experienced greater price appreciation in the economy than what the central bank had been expecting back in 2008. So well behind what central bankers have been hoping to accomplish. And it's our expectation that we're now seeing this getting back towards normal, but very unlikely to create a sustained increase from here. The impact of technology continues to keep pricing under control. whether it's bringing new industry supply in things like transportation or lodging, or it's the automation of labor. We just don't see inflation being a sustained risk over the next 5 years. The third theme comes down to monetary policy. Monetary policy is moving to the side as far as market impact. And the central banks are in a position today where they don't have a script to follow similar to what they have followed in the past. And so what we're calling this is pass-fail monetarism, where they don't exactly know what to do in normalizing interest rates. Their objective is going to be to not fail. And one of the ways they could fail is by raising interest rates prematurely and ending the expansion early. So if you look at where we sit today, the U.S. Fed has led the normalization process of interest rates. We still have a Fed funds rate that's only at 2%. The last 3 cycles, the Fed had between 400 and 500 basis points of room to cut interest rates. We're a little concerned that they're going to view this as being insufficient dry powder, and they are going to therefore push rates up prematurely and end the expansion. We think that at the end of the day, they will probably chicken out and not do that, but that's the risk that we face today on that front. Now, one of the things that will moderate them, we think, is the risk of a yield curve inversion. So you're all familiar with the yield curve basically being short to long-term interest rates. And the history is, in the U.S., and this has also worked in many of other developed markets, as soon as interest rates invert, banks lose the economic incentive to lend. The last 5 times the yield curve is inverted in the U.S. economy's gone into recession. We're starting to see Fed governors saying, we don't want to risk inverting the yield curve, so we think that will temper how far they will go to avoid failing the monetary policy test. A third theme, or fourth theme, is one that we're calling technology slow zone. The next 3 themes are a little bit more current event-oriented, not as tied to the fundamentals of growth, inflation, or monetary policy, but a lot of focus on what's happening, both the positives and the negatives from a technology standpoint. So clearly, technology is bringing lower prices across the economy, bringing more choices to consumers. What we've shown here is just the average cost globally in housing. Hotel costs versus what's now available through Airbnb, bringing new supply into the industry. Good for consumers, bad for pricing power. But what we have seen is, in the wake of the concerns about social media and privacy, some real struggling of the companies who are operating in that environment. So they will continue to be under the focus. There's now a focus of the cooperation between the technology industry in the U.S. and the U.S. government that's putting them under additional scrutiny. We think that this will continue to be an area where stock picking will be really important because they will be under the focus of governments globally, whether it's the EU or the U.S. But the overall benefits brought by technology, we think, will bear out at the end of the day. A fifth theme is one that we're calling the global repositioning system. So a little play on words on GPS, but this is getting to the issue of globalization, the slowing of globalization, and what it means for countries and companies going forward. The reality is, companies and stock markets today are extremely integrated. So if you look at the revenue sources of the different major markets around the country, around the globe, they're very diversified. So Europe's got significant exposure to emerging markets. The U.S. being, along with Canada, the most domestically focused amongst the revenue generation of the companies that are listed on those markets. So what will matter is, how do the different companies and countries react to the fact that we're seeing a diminution of the multilateral system that's been in place since World War II. So there's questioning of NATO. There is questioning of the International Monetary Fund. But to share a little fun fact, a U.S. president was quoted as saying, NATO countries have not been holding up their end of the bargain. They've not been paying their fair share of the dues. We're sick in the U.S. of covering all of this expense, and it's not going to stand anymore. So who do you think said that? John F. Kennedy in 1963. So not a new topic, but again, that's an example of the fact of separating signal from noise, not a new issue that's come to pass when we're looking at this. But one of the risks that comes from this is the trade war and the negative implications from that. The reality is, if you dig through Chinese manufacturing and all the different industries, you can see, look at chemicals at the bottom. Most chemical production is done by domestic Chinese firms. So if the U.S. puts tariffs on that, they've hit the right target. If they put tariffs on computer and electronic products, 87% of those products are produced by non-Chinese firms. So they will be hitting the wrong target with these tariffs. Just imagine if Xi Jinping decided to do some elevated surveys or quality control checks on the Foxconn plant that produces all the Apple iPhones. They could shut Apple down in a minute. So that will be an issue that remains on investor concern lists for the next couple of years. The final theme I want to hit is one that we call executive power drive, which is there has been a movement towards stronger executive power globally. And that is where we think the power has moved from central banks towards the executive branch, especially, again, in the wake of this reduced multilateral organizational power. But this can go one of two ways. What has happened with increased centralized power in the U.S. hasn't really been a problem because of the strength of the checks and balances. The U.S. dollar has actually appreciated over the last year. Whereas the concentration of power and the exercising of executive power drive in Turkey has proven to be a real problem. So it will be very important to look at country by country whether this increased concentration of power is a good thing or a bad thing. It's not universally a bad outcome. So let's talk about what this means now for the outlook for different asset classes that we're looking at and the forecast that we've got over the next 5 years. And we'll start with the fixed income piece of it. So if we look at the outlook for yield curves, so what I have put here is the yield curve that was in place this summer, what the 5-year forward was, so that is the lighter green bar. So in the same time this summer, what did the futures markets expect interest rates to do? And then the last bar is where our forecast is over the next 5 years. And there's a couple of key messages here. We think rates are going to stay relatively low for relatively long. And to give you some examples, in the U.S., our expectation is that the 3-month Treasury 5 years from now is at 2.4%, and the 10 years at 2.75%. Very little movement overall in interest rates. Europe, we've got at 0.25% to 1.25%, so relatively moved up a little bit from today, but still relatively low levels of interest rates. If we go to Australia on the far right, we've got Australian interest rates at 2.75 for the 3-month, and we've got the 10-year out at 3.50. In this environment, we still expect to see positive returns out of fixed income. One of the things that we have been very clear is that people who have been talking about the coming bear market in bonds and therefore you shouldn't own fixed income in this environment are just flat out wrong. The primary reason you own fixed income is to give you predictability about meeting your upcoming liability streams. You can't do that with risk assets. You can do that with bonds, and we think you're going to be able to do it without losing money. Another thing that we think will keep rates lower is that growth is going to moderate over the next couple of years. So what I've listed here is the expected nominal growth, because you really want to look at real growth plus inflation when you're thinking about interest rates. And we expect growth to moderate across most of the major economies. So we shouldn't expect an upward movement in rates being pushed over the next year because of an acceleration in economic activity. Let's talk about the equity picture for a few minutes. So equities have clearly benefited from the stronger economic expansion and some valuation expansion over the last 5 years. We have, in the developed markets, a forecasted return of 6% a year over the next 5 years. That contrasts with a realized return over the last 5 years of 10.6%. So we've had a great return over the last 5 years. That eats into what we expect can be realized over the next 5. We expect a premium in emerging markets to be realized. Emerging markets tend to be extremely lumpy, like 2017 with a 35% kind of return, and now giving some of that back this year. We do expect a return premium of between 2 and 2.5% over the developed markets, and that's not that far off from what had been realized over the prior 5 years, where emerging markets actually delivered an 8.8% return. So very volatile, but a solid return over that time period. And then if we look at the individual countries, you'll see on the far right-hand side, the highest return forecast is Australia. I saved the highest return forecast for whichever country I'm presenting in. So, of course, Australia benefits by having a 4.6% dividend yield. We actually have built in 1% reduction in return from valuations. So strong earnings growth, good dividend return, some cushion for valuation expansion shows us that the Australian market has a potential return of 7.5% to 8%, the best of all of the developed markets. The more expensive markets like the US, at the lower end between 5.5% and 6%. One of the things that our quantitative research very clearly has shown is that high starting valuations explain about 50% of your future return variability. So not going to win me a Nobel Prize to say when you're paying more at the beginning, reduces your return prospect and vice versa, and that certainly helps emerging markets, for example. Now, something that is going to moderate, and one of the reasons that we've been taking a little bit of risk off the table, is we have seen a slowing in earnings revisions. So we expect global growth over the next year to continue to moderate, and that has led to some reduction in the earnings outlook. And so that will cap some of the upside potential. And where we're seeing the best has been in the U.S., primarily because of tax reform, but also because of the strength of the organic recovery. Now, I am frequently asked, how can you be invested in the stock market today when stocks are so expensive? Well, I just want to say stocks have gotten less expensive this year. They've gotten less expensive because earnings growth has been very good, and in emerging markets, for example, prices have come down. So what I've charted here is where valuations were at the beginning of 2018 and where they are currently, and compared to the median valuation historically. And what you've seen is they've come down across all of the major markets, and the only market that looks expensive relative to history is the US, and even then it's not that expensive, but about 1.5 PE points relative to history. So we don't think the valuation picture today is something that should dissuade people from being invested in the stock market. Let's talk about a couple other asset classes. So real assets, which you own to help protect you from inflation. So we've studied which asset classes actually help you the best cover inflation. So we've gone from fixed income to equities to commodities, natural resources, et cetera. What I've charted here is the percentage of time each of these asset classes actually beat inflation. So what you see is fixed income doesn't do a great job. Futures-based commodities do a very good job, as do natural resources being the public equities of the commodities producers. So you definitely lean towards real assets, whether it's natural resources or listed infrastructure, as a way to help give you some inflation protection in case our forecast of Stuckflation is wrong. Something that we have been proselytizing for the last 7 years is that there is a much better return outlook using an equities-based approach to commodities versus a futures-based approach. So what this chart shows you is how often an equities-based approach beats a futures-based approach. And the proponents of a futures-based approach will cite just periods of high inflation. Well, if you look over all periods of inflation, equities trounce the futures-based approach, and they've done it at roughly a 500 basis point annual premium. So we're big proponents of using an equity-based approach to getting your commodity inflation protection. Now, a couple other asset classes to quickly run through. First is on the private equity space. So private equity has gotten a lot of press because of the discussion around valuations and how much money has been raised, and hasn't that really reduced the return potential? So there's a couple of things that are pretty clear. Investing later in the cycle in private equity tends to reduce your future return potential. There is more money at place today in the industry, but there also is a bigger opportunity set. Companies are waiting longer to go public, which gives private equity greater opportunity to invest in these companies. What this shows you is the average age of companies going public from back to 98 to 2003 all the way to current, and the average age has gone from 7 years to 10. So basically a 50% increase in the age of the companies going public. The other thing that I find to be convincing in private equity investing is the smaller the company or the lower the valuation, the better the return potential. So we tend to not be favoring the mega funds, which we think tend to pay higher prices and also tend to have to put more money to work at any individual point in time. On the hedge fund side, it's clearly been a challenging space. It's been a space that's been reliant on risk reduction. It's also a space that's benefiting from the rise in interest rates. Hedge funds have been really hurt by low interest rates, earning low returns on the cash balances that they tend to always carry. And basic 60-40 portfolio has beaten the average hedge fund in recent years. So our view is hedge fund approach is critically important to getting access to the right managers. Similar to private equity, you want to understand how you're able to get access to that manager, whether it's your personal relationships or the manager you're using, because access to the average hedge fund isn't going to cut it in this lower alpha environment. So let's review for a second how we did 5 years ago. When we put these asset class return forecasts out, you do them with a little bit of trepidation. Getting individual asset class returns accurate, of course, is challenging, but we decided to hold ourselves to that standard. Let's see what we realized, and let's see what kind of lessons can be learned from it. So 2013, the blue bar is what the actual result was, and the green bar is what we predicted. So what you can see is that there are some meaningful differences. Let's start with some of the more pleasing comparisons. Investment grade, we thought would deliver 2.8%. It delivered 2.3%. Not too far off, but fixed income's not that hard to forecast. Emerging markets, we thought would deliver 10.1%. They delivered 5%. Developed markets outperformed at 10.6%. We thought they would only develop 7.4% return. So individual asset classes were really kind of all over the map. And if you've got experience doing this, you know that's just the nature of the beast. What's the follow-on? Well, the follow-on is, what's the benefit of diversification and what can be realized through this? So if you start to bucket these assets into risk assets, so stocks and real assets and high yield bonds. Risk control assets, so investment grade bonds and inflation protected and cash. And then throw it all into a diversified portfolio. What do you see? So in the risk asset category, we thought that a diversified basket of risk assets would deliver 7.7% return. It actually delivered 8.6%. So we got a positive upside surprise out of risk assets. Risk control assets were below expectation, 2.7 versus 2.1. Put it into a fully diversified portfolio, it actually was really close. At a return expected of 5.8, came in at 6.1. So to me, that demonstrates the benefit of diversification and the benefit of going through the whole strategic asset allocation process. But the second point I would offer, and this comes back to the accounts where tactical asset allocation can be useful, think back about these deviations. Now, if you're doing a tactical approach, you're not locked in to these individual allocations and these return expectations. So during this period, for example, we were underweight emerging markets, much of it, underweight natural resources, overweight the U.S. That added 130 basis points a year through this period by making these tactical bets. But the most important message to be realized is the one that diversification works, because picking the individual asset class return forecast is not very fruitful. So let me wrap up with a couple of final comments. So what are we worried about that could disrupt an environment that we still think looks okay for taking risk today? Even though we've pulled some risk back, we're still invested across the markets. The two primary risks we're worried about are the Federal Reserve making a mistake, and we focus on the Fed because they're the furthest along. Maybe they ignore the risk of inverting the yield curve and keep raising interest rates. We think that would be a mistake. The second risk we worry about is the risk of a trade war. Some economists will look at the individual sectors that are being targeted and saying, well, if you add up these sectors, it's only 0.3% of the Chinese economy. It's really not that impactful. Well, here's the problem. The sectors that would be hurt by a real trade war with China represent a much, much bigger percentage of the U.S. stock market. Their profits would be really hurt. And one of the things that, if those of you heard a discussion this morning about why is there so much focus on the U.S., does the U.S. really lead everything? Well, nobody said the following, that the U.S. stock market is over 50% of global equities. So that's why it's so important, and that's why we do worry about the risk of a trade war. The Trump administration has been kind of all over the map on this. One of our phrases around, well, there's two phrases that we've talked about in trying to analyze the current political environments in the U.S. The first is, watch what they do, not what they tweet. So policy is really what matters. The second is, and this came up during the election, and I've never forgotten it to this day, and people still make this mistake about President Trump. Don't take him literally, but take him seriously. So he says all kinds of things that are sometimes hard to understand. But understand that he is serious about the trade issue. He has been for decades talking about this, and so that's why that remains a key risk for us. So those are some comments about how we are thinking about things from a longer-term standpoint, lower returns because we've had a really robust environment over the last 5 years, and how we position things tactically today. So with that, I welcome Del up to get into some Q&A, and I look forward to your questions.
Please put your hands together for Jim McDonald. Thanks, Jim. That was brilliant. I've been sitting at the back watching the presentation and looking at all the audience questions come in. We have quite a few, a lot of interest in your talk, so I'm just going to get straight into it. One of the first questions we have for you is, there has been some talk of US companies experiencing cost pressures and labour shortages. Will this trigger inflationary pressures and higher interest rates? I know you touched on this briefly.
Sure.
Yeah.
So I have the benefit of going around the U.S. and meeting with our clients, a lot of whom are business people. And we have been hearing the issue of labor shortages for 4 to 5 years. And what the reality is, companies have been unwilling to pay up. So the low level of unemployment has actually turned out to be a growth retardant because companies can't get enough good workers and they're not willing to increase their pay that much. Now, what happened in the second quarter of this year? U.S. growth was really strong. Productivity took off. So there is a false question that gets put out by people saying if wages go up, that's going to be a problem. You need to think about good wage gains and bad wage gains. Good wage gains are those that happen when the economy's good, productivity's good, they pay workers more, workers can spend more, corporate profits do fine. If we get sustained wage increases, we think it's only happening in that environment. Bad wage gains are when employers are forced to pay people more and they can't recoup it through productivity. We just think, maybe similar to Australia, that the U.S. corporate sector has got the stronger hand.
A really popular question, and one that could probably relate to many people in this room, is since most of the super funds in the room are DC funds with no liabilities to match, what is the case to invest in bonds today?
I think the case to invest in bonds is principally for liquidity management. It is really not for the capital return potential. We don't think you're going to lose money in them, but we think you will do meaningfully better in risk assets. So I would think that if you are in a position where you do not have those liquidity demands over the short term, you would be extremely weighted towards risk assets.
In terms of emerging markets, they have the higher 5-year outlook, but the portfolio is only tactically 1% overweight.
Yep.
What needs to change in emerging markets to see a higher tactical weight? You can drink some water if you want. I know you've been talking non-stop. You can take a little bit of this.
I did just get off 25 hours of planes getting here today. So emerging markets are under review in our allocation because we do have some concerns about the risk of further contagion. And part of the environment that's different today than 5 years ago is for decades, the U.S. has been one that would come out and calm the markets when disruption started to happen. So if Turkey started to have problems, historically the U.S. would be a voice of calm and say, we will come in and we will support the IMF, and that helps calm market nerves. Today that's not the environment. Today what happens when Turkey gets into trouble? The U.S. slapped more sanctions on. So we're in a situation today of saying, we think this has probably got a little bit more time to go before we see that stabilize. Without a doubt, the growth picture out of China is the most important driver. Chinese growth has been slowing. As I mentioned in my remarks, they're doing a lot to try and offset that. So signals about infrastructure spending starting in June, things like cement consumption have started to increase pretty significantly. But I would say settling down of the contagion concern and evidence that Chinese growth is improving would be the two most important things.
Another question on emerging markets. They always seem to look underpriced, but they fail to deliver. Why?
Well, I wouldn't say they fail to deliver. I would say that they are really lumpy in their returns. So being a momentum investor in emerging markets is a sure way to get crushed, because you will buy midway through 2017 after the recovery's already happened, and you will miss a chunk of the upside potential. One of the things that you have to be very cognizant of in investing in emerging markets is there is big share dilution that goes on there. There are serial diluters in the emerging market world, and you need to include that in your expectations of emerging market returns. So we do have an expectation that they will deliver a premium over the next 5 years. A good chunk of that is because we expect a better valuation picture as compared to the developed markets, because there is some valuation cushion.
If you want to take a sip of water, you can. We're taking questions from you guys through the conference app, but of course, if you've got a question in the audience and you'd like to ask it in person, just put up your hand and we'll get a microphone to you as well. Jim, what's your view on agriculture as a potential investment option?
So our approach to natural resources is a diversified one. We don't have internal expertise that looks at agriculture versus metals versus energy versus water or timber. So we will do one of two things. We will either invest in a fully diversified natural resources basket, because the cycles can be very uncorrelated, which works well from a diversified standpoint, or we would hire an active manager that makes those bets. So internally, we don't have an individual view on agriculture versus the other commodities.
Employees' portion of corporate earnings are at low levels, similar to levels we've seen before the Great Depression. Does the large income inequality represent a risk?
I think it does, but I want to share a framework on how to think about things like the income inequality issue. We have a consultant that we use that talked about the Italian debt situation. And the analogy he used is there's a difference between a chronic problem and a crisis. So Italy's debt situation is a chronic problem. It's not a crisis. Turkey's in a bit of a crisis. Income inequality is a chronic problem that is being worked through politically. It is going to be a long-tailed issue that we will be worried about and will be focused on and seeing, does it start to create pressure on cost structures, maybe in individual countries or individual industries? We think it's nowhere near being a crisis that would lead you to say, you know what, it's time to reduce our exposure to equities. Because if this was a crisis, and there was a major redistribution of profits from corporations to the worker, you would want to reduce your exposure to the equity markets. We just don't think that's a likely forecastable event over the next 5 years.
What about Brexit? Is it a chronic problem or a crisis?
So Brexit is a little of both. When Brexit occurred a couple years ago, the vote, we actually reduced our forecasted return for European equities by 0.5%. We returned our British UK forecast by 2 percentage points. So meaningful reduction in the outlook for UK investments in the wake of that. It's unclear what's going to happen on this front. We may get presented with a good trading opportunity here. This is a permanent issue, though. This has permanently injured the growth potential of the United Kingdom. I like to joke to my colleagues in London that I like to come to present to them in our London office because UK politics make the US look good. They really, we can talk about all the political hailstorms that go on in the US. They really haven't affected our economic outlook. What the UK did themselves really hurt their economic growth potential. And so I think that is both not a chronic problem in that it's not going to go on for the next 5 years because Brexit's really got to be resolved by next year, but it's already reduced the economic growth and the investment return potential for UK assets.
Now, with ESG such a topical subject, how many degrees of separation does Northern Trust look for with investments that you undertake?
So we do think that ESG is a force that is just gaining momentum. And we're seeing it in all aspects of our business, whether it was some early leadership in Europe, clearly very important in Australia, increasing interest in the States, and also increasing interest, in my mind, interestingly, on the private wealth side. So I think that this is going to be a very strong long-term trend where there is going to be a lot of focus on looking at an ESG approach to managing portfolios, not only in the equity space, but increasing interest that we're seeing on the fixed income side. So this is a trend that is here and that is only going to continue to gain share.
What are the implications of a trade war for Australian assets, particularly, I guess, the US-China trade war?
Well, I think I heard some of the discussion from the panel earlier today. I think it was Shane and Stephen. Australian economic growth and market performance is very closely tied. And it was interesting to me to hear Shane say tied more closely to the U.S. than to China. I would have thought that it was more of a balanced impact. But clearly, if there is a blowout of a trade war between the two, there's going to be nowhere safe to hide. So especially if you think about the impact of the manufacturing in the public companies in the United States, their reliance on the supply chains in China, and how that could hurt not only profitability but global risk appetite, there would be washback to Australia, I think, without a doubt.
So with that in mind, what is it about your portfolio that worries you most? What have you assumed that may not be true?
So I think I've articulated the two most clear ones, which is, do we have a central bank mistake? And secondly, do we have a trade war blow up? I would say the third that is the hardest to know, and this would get into the black swan category, And so it was interesting that they changed the title of the earlier presentation today from when will the next global financial crisis happen, because nobody knows, to what might lead to the next downturn. When I get asked the question of what could lead to the next global financial crisis, or when will it happen, I don't know where it's going to happen, but the most likely culprit will be that we've had a period of very low interest rates for a very long period of time. And so money has flowed to places with higher yields. We have very strong conviction that interest rates are going to stay low for a long period of time. So that will reduce the pressure of rising rates leading to credit problems and funding problems. So as we think we're sitting here 5 years from now, you're still going to see very low rates globally. But that would be something that would worry me, that if there was a change on that front. And we're also increasingly seeing more people coming to our view that rates are going to stay low for long. That would be a severe disruption.
We touched briefly on this topic of ESG. So another question just sort of related to that. Does NT put any responsible investment filters through its portfolios and or consider impact?
Absolutely. We have a substantial, more than tens of billions of dollars of assets under management with ESG mandates. And they can be relatively standard to very customized, and it's on both the equity and on the fixed income side. That's not my area of particular expertise, but we have got, I want to say, 80 billion-ish US under management with ESG kind of mandates. No one's from compliance here, so they can't fact check me on that. But it's a very substantial part of our practice that we've got a lot of resources dedicated to.
To what extent do you think about climate change in your asset allocation modelling?
So climate change is one of those very difficult items to forecast. We have not put a specific adjustment for expected changes in growth or investment return forecast in our expectations for that. It's something that we debate every year, and if we get to the point where we've got a better ability to consider quantifying that, we will do that. But today we don't have, and I'm not aware of many that have a quantified impact on the strategic asset allocation view, for example, because of the potential impact of climate change.
A question here from Michael Colo. How do you think AI will change the balance of economies and therefore asset prices globally?
Yeah, so I don't know that I see AI changing asset prices globally. I think from an economic standpoint, it's really a continuation of the trend that's been in place, and it's led to some of the issues about income inequality that we've been experiencing. It is just another example of automation. Mm-hmm. So it is going to continue to put white-collar jobs at risk as more things get automated. It's going to continue to put blue-collar jobs at risk. So it is an inexorable trend, not that different that we've experienced over the last 5 to 10 years, but it's something that we also think will keep pricing pressure under control, because it's just another thing that we think keeps employees from being too bold in looking for wage increases. If they are worried about the potential of their job being automated, mm-hmm. they're happy to have a job and not have it be automated versus going in and demanding a substantial wage increase. So I would say that it's a continuation of the trend, probably very supportive of our view of Stuckflation. One of the fun facts that I read recently that I didn't think to mention during the presentation that also gets to this issue of low inflation and is somewhat related to the artificial intelligence and just the sharing of information and the sharing economy is what's happening in one of the largest industries globally, which is automobiles. So there was a lot of discussion earlier today about the German companies and how they're leading the forefront of research and they're trying to be ahead on the value-added curve. Well, BMW has recently come out and forecast that in 10 years' time, one sharing ride car is going to replace 3 currently privately owned cars. So BMW is planning for a major transformation of the private transportation business as people stop owning their own cars and start sharing. So think about the ripple effect of that on the economy, where there's less demand for traditional automobiles, more sharing, more utilization of existing resources. That to me just screams continued contained pricing power, because companies are going to see falling demand for their traditional products.
We have around 4 minutes left with Jim McDonald, so if you've got any questions, I suggest you get them in now. I've got a couple more over here. Industry funds' internal teams have delivered strong performance in a rising market. How do they need to adapt to deal with potentially lower returns in the future?
Well, I think one of the most important things is preparing trustees for it. So one of the key issues around using our 5-year forecast, for example, is an ability to say, well, this is what we've realized over the last 5 years. Understand it's unlikely to be able to be realized over the next 5. And what the last thing you want to be doing is reaching too much for return, especially if you've got a longer-term horizon. So we've faced this significantly in the U.S. over the last 5 to 10 years because of substantial underfunding of defined benefit pension plans. And there has been some bailing out because of very good asset returns, but a real hurt because of the low interest rate environment keeping liabilities relatively high. The plans that have reached for too much return would be the ones that would be most vulnerable if we do get a correction or a substantial rise in rates. So my number one piece of advice around this is managing expectations about what realistic returns are. You can only get what the market's going to give you with then the potential for some alpha, and setting expectations appropriately, I think, is probably the most important step.
Okay, and I'm going to end on this last question from Jared Noonan. If the Trump erraticism is confronted with a reversal at the November midterm congressional elections, would that be a good thing or a bad thing for Outlook?
Sure. So a couple comments on that. A lot of focus on the midterm elections. Our view is it's really not going to change very much. So let's say, for example, that the Democrats take the House of Representatives. That's a possibility. It is an upset for them to take the Senate. If they just take the House, all that's going to allow them to do is start a bunch of investigations. They're not going to be able to pass any legislation. Even if they took the Senate, the President, Trump, could veto anything that he doesn't agree with. The major legislation that got passed this year, which was the tax reform, was passed through kind of a loophole through the budgetary process. They couldn't get 60 votes, which is what's required to break a filibuster to pass traditional legislation. So there will be huge noise around the midterms. Our very strong view is it's really unlikely to change the legislative environment, and therefore probably won't be very substantial. There is a lot of focus about the impact that a president has, and we think it's really overstated. And I'll give you a quick example. Barack Obama was talked about as being a socialist, left-leaning, anti-energy, tree-hugging president. Guess what happened under Barack Obama's presidency? The shale revolution in the United States, a doubling of energy production in the U.S., and the legalization of the exporting of oil for the first time in something like 40 years. So that's a good example, I think, of the check and balance and the potential of overstating the impact that just the president can have. Just like in Australia, the U.S. has really got really good checks and balances that prevents any one arm from having too much power at any point in time, and it's, I think, done both of our countries well.
Lovely. Well, if there's one thing markets like, it's a bit of certainty, so it's good to know it's not going to rattle people too much. Jim McDonald, thank you so much. Please put your hands together for him.